Let's get started with the second conversation that we've lined up for you, and that has to do with a strategy that involves fixed income investments, specifically investments into debt mutual funds. Joining me to talk about it is Suresh Sadagopan, the founder of Ladder7 Financial Advisors. Thank you so much, Suresh, for taking the time. And this is something I think that makes sense to talk about in the current context. You're talking about interest rates rising the world over. You're talking about central banks becoming more hawkish about inflation, the potential for yields to go much higher than they are right now. In that scenario, you're trying to protect your capital, and that's where a target maturity scheme or a roll down strategy would come into play. Could you explain how these work, though?
So I think you have set the context. So from this is probably the lowest point as far as the interest cycle is concerned, and probably for multiple reasons, the interest rate may start going up. So currently, RBI has maintained the accommodative stance. They have not increased the repo rate or reverse repo rate. So they have kept it at the same level. So I think they want to ensure that the growth is not hampered. So they want to wait for a bit longer to start increasing the interest rate in the system. So which means what you said is absolutely right. I mean, the yields will start going up. So we will have to be, this is a time to be very careful when we are investing in debt-oriented products, especially debt mutual fund, which is essentially an aggregation of various papers from the entire debt space. So now let us come to the specific point that you mentioned about target maturity strategy and roll down strategy. See, as far as target maturity is concerned, see, as the name itself indicates, there is a particular point at which all the papers will mature and the fund itself probably will give back the money to the investor. So that is a target maturity strategy. I mean, best illustrated through a fixed maturity plan. We already have a fixed maturity plan. That is actually a target maturity strategy where all the papers will mature around whatever 3 years, 4 years, whatever is the point. Now, as far as the roll down strategy is concerned, okay, before going to the roll down strategy, as far as target maturity is concerned, typically what happens is the liquidity may not be really there too much. At least if we talk about the FMP, FMPs are supposed to be listed on the stock exchanges, but we find that it is thinly traded or not traded at all. So essentially, practically speaking, there is not much liquidity. Now, that is where the roll down strategy actually comes into the picture, where again you have a target date on which all the papers, underlying papers will mature. And as and when they get further inflows or as and when they get further interest, they will be, the fund manager will be investing in such a way that they will mature around the same time as the other papers. So that is a roll down strategy where over a period of time, the maturity of the fund itself will keep going down and down till the point that maturity is reached. So this is typically an open-ended fund in this particular case. So it actually solves the problem of a typical liquidity problem in the case of an FMP, that it solves that problem because this is going to be, completely available for liquidation at any point in time through the mutual fund AMC route. So that way, it's a good product. This, in a sense, can be, I would not say directly you can compare with any fixed income kind of a product. This is still subject to a bit of volatility, but there is a level of predictability as far as the portfolio is concerned because you are buying the portfolio. The fund manager is buying the portfolio and holding to maturity, which means that the portfolio yield to a great extent is locked in while buying those papers. Now the volatility can come, of course, if the interest rates go up, the volatility can come. And of course, when the person, the fund manager invests further money that is coming in by way of new flows or by way of interest, it can be at a higher or lower yield. So the final yield which one will, final interest that one will get, final return that one will get can somewhat vary from what initially one thought the return would be. So that is broadly about the roll down strategy.
True that all target maturity strategies have a lock-in, or do you have some that are open-ended?
See, the roll down strategy is a version of target maturity strategy only. In the case of a target maturity strategy, which is implemented essentially in the closed-ended fund, I mean, it clearly matures at that point in time, and the money is given back to you. In the case of a roll down strategy, it is implemented in an open-ended fund. So in that sense, so therein lies the positive and therein lies the negative. In the sense that in the case of a roll down strategy, at any point in time, you can actually, exit from that particular fund, or you can enter that particular fund. Okay, so that is the positive. The negative is that, see, again, this is going to be subject to volatility, which really cannot fully predict the return. So if you exit in between, you can exit at a higher or a lower point. So ideally, the roll down strategy, you should not worry too much about the volatility. And roll down strategy actually works wonderfully well only if you have the ability to participate in that for the entire tenure. So only then it works well. And of course, tax efficiency in both target maturity and roll down strategy is the same as any other debt mutual fund, which is if you hold on for 3 years or more, you can take advantage of indexation and 20% tax. So effective taxation comes in single digit, so which is a positive.
So that all our viewers are on the same page, I'm just going to illustrate what you said in terms of a roll down fund, which is to say that if the strategy of the fund house is to have, when they start off this fund, a 5-year paper, they will buy a bunch of 5-year papers which they will hold to maturity, and then maybe 1 year down. Now, when there's 4 years left on that paper, if more people come with their money and say we want to invest in their fund, they will at that stage buy 4-year maturity papers. So papers that mature in 4 years, and the overall maturity of the papers that they hold or the bonds that they hold will be maturing in 4 years, and this keeps going down as and when the fund keeps getting more money. So that's essentially the strategy. What are the biggest advantages? One must understand why this is important, right, Suresh? Because in a sense, this is primarily aimed at having a level of predictability to the returns that you get in a fixed income scheme, and also to protect your capital, right?
Yeah. So if you look at these kind of funds, I mean, any fund which has this kind of a strategy, roll down strategy or target maturity strategy, at least the ones that have been launched now, it will be primarily in the gilt space, or it will be in a AAA PSU bond space, or a state development loan, in those kind of cases. So if you look at any of these three things, the risk is extremely low. So, especially when in a situation like this, when the economy is kind of recovering, there can be, there can be certain question marks in the minds of the investor, whether what I'm investing, is it appropriate? Is it a good place to be in? So the question as far as the risk is wonderfully taken care of in the products which are available today in the market. So if you have the tenure, and you don't have to worry about the volatility, you are kind of, in a sense, you are locking in on the return. Of course, I hasten to add that based on the flows in between, based on the interest reinvestment at various points, the return can be slightly vary. So, but it is reasonably predictable. So the only thing which one has to bear in mind is that this is for a slightly longer term investment. Most of the papers, most of the strategies which are available today, most of the funds which are having these things, is in the ballpark of 5 years or more. So if you have that kind of a long-term tenure, and especially if you do not require an income, or if you do not want to take out the money from time to time, you are really looking at investing in some place safe, and it gives a 6% plus kind of a return after tax. So then this will be fantastic. And again, another psychological thing which investors have to understand is that there can be interim volatility. Even if it is a 5-year strategy, if the interest rate starts going up, there can be volatility. You can see probably your fund may be giving maybe 3%, 2%, 4%, whatever. So you should not get too much worried on that, because ultimately it will catch up, because the paper, whatever is the paper, it has to be redeemed at par. Suppose it is a 100 rupee paper, it will be redeemed at 100 rupees, even though it may be quoting at 97 or 98. So if you hold it to maturity, it will work wonderfully well. So one of the downsides as far as this is concerned is that normally in the case of an open-ended fund, this kind of a roll down strategy, this is an open-ended fund. So what happens is, suppose it is a 5-year strategy, they are not going to inform you as an investor. They are not going to inform you that, okay, this strategy is coming to a close and we are now going to launch a new strategy. So you have to be aware, you and the advisor, if there is an advisor, you will have to know that, okay, this is ending in 2027 March, around March 15th. So if you know that, you have to keep track of that and you have to exit. If you do not want to participate in the next strategy, you have to exit around that time. So this is a kind of a negative in the sense that you have to monitor when the strategy is actually kind of closing. The other thing is, I mean,
That
this is
sorry,
not an ideal.
uh, Suresh, I want to ask you about that a little bit. The fact that you have to be aware of the strategy that is being employed by the fund house. Now, I think that this is important because a few schemes or a few fund houses pivoted their existing fixed income schemes and they started roll down and investors in those schemes were not really aware of what had happened, that pivot that had taken place. So how does one, from the investor's standpoint, pay attention to these things? And it has to be the fund house that informs the investor, but I think the biggest issue is that the investor does not read all the fine print all the time.
Correct. So, I mean, even assuming the investor is reading the fine print, this particular strategy is probably not part of that communication. Very few fund houses may very specifically say that we are implementing a roll down strategy. What is happening now is that I'm seeing that many fund houses are also coming out and actually saying that we have this kind of a strategy. But again, not too many have done that. So from the investor point of view, it is a bit of a problem. I do understand. So in that sense, if they do not know when it is actually maturing, it's a bit of a problem. The only positive thing I can say about this whole thing is that it is being invested in very high quality papers. So that is a positive I can say. But yeah, if you don't know when to exit, if you don't know the time of the exit, it's actually a bit of a problem.
But let's talk about then, maybe you can illustrate a few that are following this roll down strategy, because it's not something that is advertised per se, right? It's not like you can go and buy it, like how you would say, oh, today I want to go and buy a corporate bond fund or I want to buy a gilt fund. You don't go out into the market and find funds basis looking for a roll down fund. You have to ask your advisor, hey, can you tell me a few funds that operate in this manner? So what are the funds that you've seen that currently operate roll down strategies?
If you are looking at Nippon, Nippon has one very long-term fund which is investing in government gilt. Okay, so like that, they have two different funds which they are investing in. I don't remember the name right away. That one fund which is investing in Government of India paper, that is a very long duration, more than 20-year duration. They are doing a roll down strategy. Like that, now many fund houses, IDFC also has a couple of funds. I think corporate bond fund and I think banking and PSU debt fund, I think they are following that strategy.
Right.
See, sometimes what happens now, Alex, is that we have to figure out from some of the communications we get. Sometimes it is explicit, sometimes it is not that explicit. Sometimes we understand from maybe some fund manager call. Sometimes they say that this is what we are actually following. We may not have exactly said, but this is what we are actually following. So in a sense, I would say that investors are better advised to properly search for which funds are following this kind of a strategy. And if they search enough, they'll be able to know. Because while I am reading various articles, even I am able to see that which funds are following the roll down strategy, which funds are following some other accrual strategy, and so on. True. The other thing is, of course, I mean, if you have an advisor, then that advisor, based on the particular requirements of the person, they can suggest whether the target maturity or a roll down strategy will be appropriate and which fund is appropriate, which duration is appropriate.
Yeah, and duration is the key thing, right? Because something like this, a strategy like this, you would think that when it comes closer to the maturity stage, when it kind of then becomes more shorter term in nature, is not as lucrative as it would be if you were getting in at the longer end of the spectrum, right?
Correct. So the point is, I mean, long and short, what I would say is that people should have that duration, I mean, which is typically 5 years or more. If they have that horizon, if they do not want any kind of an income in the interim, and if they are fine with the yields currently. So some of the people say, I mean, why should I lock in at 6% kind of yields? Probably it will go up. While it can go up, we don't know which way it will go up. Like if you look at stock markets, nobody knew that it will rally for say 18 months. If you look at April 2020 onwards, nobody knew. So the same is with bond market. Bond market can also surprise positively, negatively. So I mean, if they are fine with the available yields, which is roughly about 6% plus currently, and they are not worried too much about the interim volatility, these kind of funds are good. Tax efficiency and liquidity is anyway a part and parcel of the any kind of a debt fund. So for those kind of people, this kind of a fund is actually good. I mean, 6% plus post-tax yield is, in my opinion, very good for a product which does not have any real risk.
And in the context of where the interest rates are, the policy rates are. Thank you so much, Suresh, for joining in and for giving us that clarity and perspective on the roll down strategy.